There is a rule buried inside the American banking system that affects every single person with a bank account in this country. It does not matter if you are wealthy or working paycheck to paycheck. It does not matter if you have ever filed a tax return late, owed the government $1, or had so much as a parking ticket. This rule applies to you, and the overwhelming majority of Americans either do not know it exists, do not fully understand how it works, or have dangerously wrong ideas about how to deal with it. It is called the $10,000 rule. And in 2026, with the IRS using bank data at a historic rate to pursue investigations, and with suspicious activity report filings hitting all-time record highs, understanding this rule is not optional anymore. It is essential financial self-defense. Here is what makes this topic so important right now. The $10,000 rule is not just a simple reporting threshold. It is the entry point into a much larger, much more complex surveillance architecture built around your bank account. There is a second, lower threshold most people have never heard of. There is a federal crime that innocent, law-abiding Americans are accidentally committing every single day. And there are documented cases where the government seized hundreds of thousands of dollars from people who had done absolutely nothing wrong and kept it for years while they fought in court to get it back. Today, we are going to pull back the curtain on all of it. By the end of this video, you will understand exactly how this system works, what your rights are, and most importantly, how to protect yourself. To truly understand this rule, you need to understand where it came from, because the history tells you a great deal about how the government thinks about your money. In October of 1970, Congress passed Public Law 91-508, a law commonly known as the Bank Secrecy Act. It was created in direct response to growing reports of people physically bringing bags full of cash of questionable origin into banks for deposit. Congress was alarmed that American citizens might be using the bank secrecy laws of foreign countries to conceal illegal activities, and they wanted a way to track large cash flows through the financial system. Bankrate Secrecy Act required every U.S. financial institution, including banks, credit unions, and money service businesses, to file a currency transaction report, known as a CTR, with the Financial Crimes Enforcement Network, or FinCEN, for any cash transaction exceeding $10,000 in a single business day. This requirement applied to deposits, withdrawals, currency exchanges, and other cash transfers. The original threshold was set at $5,000, and Congress raised it to $10,000 in 1984, where it has remained ever since. NerdWallet. Think about that for a moment. The threshold has not moved in over 40 years. The $10,000 limit that triggers a government report today is the same $10,000 limit that was set in 1984. Adjusted for inflation, $10,000 in 1984 would be worth well over $30,000 today, which means the net of this reporting system has grown dramatically wider over the decades, catching far more ordinary Americans in its reach than Congress originally intended. When a CTR is filed, it captures extremely detailed information about you and your transaction: your full name, address, Social Security number or taxpayer identification number, the amount of the transaction, the type of transaction, and the account numbers involved. Your bank must file this report with FinCEN within 15 days of the transaction. The law requires your bank to report any transaction exceeding $10,000, not because they are necessarily suspicious of you personally, but because large amounts of money changing hands could indicate possible illegal activity. The report is filed. A record is created, and it sits in a federal database where it can be accessed by law enforcement and tax authorities. CNBC Now, here's the reassurance most people need to hear at this point. Simply depositing or withdrawing more than $10,000 in legal money does not make you a criminal. It does not automatically trigger an audit. It does not mean an IRS agent is going to show up at your door. Banks are required to file this report, even if you have done absolutely nothing wrong. The filing is routine. If your money is clean and your taxes are in order, you have nothing to fear from a CTR. But, and this is critical, the CTR is only the beginning of the story, because there is a second layer of this system that is far more dangerous for ordinary Americans. FDIC. Most people who know about the $10,000 rule assume that keeping their transactions under that number keeps them off the government's radar entirely. This is one of the most dangerous financial misconceptions in America. Because the $10,000 CTR threshold is not the only wire your bank account is connected to. Banks are also required to file what is called a Suspicious Activity Report, ASAR, for any transaction involving $5,000 or more where the bank suspects that funds may involve money laundering, fraud, or an attempt to evade federal reporting requirements. The activity does not need to be proven illegal. Suspicion alone is enough to trigger the filing requirement. Accounting Today banks must file a SAR within 30 days of detecting suspicious activity. And here's the part that will genuinely shock most people. The filing is completely confidential. Customers cannot be informed that ASAR has been filed on their account. You will never receive a letter. You will never get a phone call. You will never know it happened, unless federal investigators eventually come knocking. What triggers ASAR? Banks use transaction monitoring software that constantly scans for unusual patterns. Red flags include rapid cash deposits, wire transfers to high-risk countries, transactions that are wildly inconsistent with a customer's stated occupation or income profile, and, critically, a series of transactions structured to fall just below the $10,000 CTR threshold. House. In 2025, SAR filings by banks hit a record high. The most commonly reported category was suspicion concerning the source of funds, followed by transactions with no apparent economic, business, or lawful purpose, and then, notably, transactions below the CTR threshold. That third category alone tells you everything you need to know. Banks are specifically trained to flag people who appear to be deliberately staying under $10,000. And the federal government is using this data aggressively. In February 2026, IRS Criminal Investigation reported that 94% of all their cases were searched against Bank Secrecy Act data, resulting in more than 3.9 million searches of BSA filings. Nearly 80% of IRS criminal investigations had primary subjects associated with suspicious activity reports. And when utilizing BSA data in 2025, IRS criminal investigation achieved a 98% conviction rate, with average prison sentences of 42 months, more than $450 million in asset forfeitures, and nearly $500 million in restitution. Criminal defense attorney Tampa read those numbers carefully. A 98% conviction rate. That means if the IRS builds a case against you using your banking data, you are almost certainly going to lose. The system is designed to win, which is why your first line of defense is never giving them a reason to look at you in the first place. Now we arrive at what is, without question, the most important and most misunderstood part of this entire topic. It is a federal crime called structuring, and the stories of innocent Americans who have had their life savings seized because of it are nothing short of extraordinary. Under 31 U.S.C. Section 5324, structuring is defined as intentionally breaking up transactions into smaller amounts specifically to avoid triggering the $10,000 reporting requirement. It is a federal crime regardless of whether the underlying funds are completely legal. The money can be entirely clean, earned through honest, hard legal work, and you can still be charged with structuring based solely on the pattern of how you deposited it. NerdWallet. The penalties are severe, up to 5 years in federal prison, and fines of $250,000 for amounts under $100,000, doubling to 10 years in prison and $500,000 in fines for larger amounts. NerdWallet. But here's the part that should alarm every single American watching this video. The government has used these laws, not against drug dealers or money launderers, but against completely innocent small business owners who simply did not know the rules. Take the case of Andrew Clyde. He is a U.S. Navy veteran and the owner of a licensed firearms business in Georgia. In April 2013, the IRS seized his business bank account without charging him with any crime. The reason? He was regularly depositing several $1,000s of cash from his legitimate business operations, deposits that were under $10,000, which he made routinely because that was the nature of his cash flow. The IRS originally seized nearly $950,000 from his business. After fighting through federal court, he was eventually forced to forfeit $50,000 to the IRS and spend over $100,000 in legal fees, simply for depositing his own legally earned money in a pattern that attracted government suspicion. His case was not an isolated incident. Jeff Hirsch, who ran a convenience store distribution business on Long Island, had over $400,000 seized by the IRS for alleged structuring. Randy Sowers, a Maryland dairy farmer, lost $29,500. Neither man was charged with any underlying crime. Their money was simply taken. The Motley Fool. According to a landmark study by the Institute for Justice, from 2005 to 2012, the IRS seized more than $242 million in more than 2,500 cases for suspected structuring violations. Annual seizures increased 5-fold over those 8 years. And critically, 4 out of 5 of those forfeitures were civil, not criminal. That means the IRS faced a lower evidentiary standard, did not need to secure a criminal conviction to keep the money, and the property owners had fewer legal rights in fighting to get it back. Modern Treasury. The average IRS structuring-related forfeiture took nearly a year to resolve, and nearly half of all the money seized by the IRS in those cases was not ultimately forfeited, which raises a deeply troubling question. If the IRS could not ultimately justify keeping nearly half the money it seized, why was it taken in the first place? Modern Treasury. The answer, according to critics and lawmakers on both sides of the aisle, is that civil asset forfeiture laws created a system where seizing first and asking questions later was simply too easy and too profitable. Federal civil forfeiture fund deposits went from $93.7 million in 1986 to exceeding $2 billion annually by 2019. This became, in effect, a revenue stream built on the backs of innocent Americans who did not understand the rules. Fraud fighter. The good news is that Congress has taken notice. In 2014, the IRS's Criminal Investigation Unit introduced a new policy stating that it would no longer pursue the seizure and forfeiture of funds related to legal source structuring, meaning cases where the underlying money was legal. Reforms have been passed and debated over the years to raise the bar for government seizures and give property owners more rights. But the underlying law still exists. The power is still there. And the lesson from every one of these cases is the same. The best protection is transparency, knowledge, and keeping your financial behavior above reproach. Internal Revenue Service. Beyond the CTR and the SAR, there is a third layer to this surveillance system that most Americans have no idea about. And this one is arguably the most powerful tool the government has. Under Internal Revenue Code Section 7602, the IRS can issue an administrative summons to compel your bank to hand over your financial records, without a warrant and without a judge's approval. The IRS uses Form 2039, known as an IRS summons, which is a legally binding request requiring your bank to provide whatever financial information the IRS is seeking. You will be notified that a summons has been issued, but by that point, the process is already in motion. Institute for Justice. What makes the IRS decide to dig deeper into someone's banking history? Large, unexplained cash deposits, excessive cash transactions, offshore accounts, transactions inconsistent with reported income, and sudden, unusual financial activity are all known triggers. And if your bank deposits do not match the income you reported on your tax returns, the IRS will investigate. Institute for Justice. This last point deserves particular attention in 2026. The gig economy is enormous. Millions of Americans earn income from freelance work, side businesses, online sales, rental income, and cash-based services. Income that is legally required to be reported, but that many people quietly overlook. If money is flowing into your bank account that does not show up on your tax returns, you have exposure. Not because you moved money in suspicious patterns, but simply because the numbers do not add up. Under 12 CFR 21.11, national banks are also required to report known or suspected criminal offenses, as well as transactions over $5,000 that they suspect involve money laundering or violations of the Bank Secrecy Act. This means your bank has multiple independent obligations to flag unusual activity involving you, and they fulfill those obligations quietly without ever telling you. Institute for Justice. The most important takeaway here is this: the government does not need to catch you doing something dramatically wrong. It does not need a dramatic sting operation or a whistleblower. It simply needs your bank deposits to tell a story that conflicts with your tax records, and then the math does the rest. So after everything we have unpacked, the CTR, the SAR, the structuring laws, civil asset forfeiture, and the IRS's power to access your records, what does a law-abiding, financially responsible American actually do to protect themselves? The answer is simpler than you might think, and it starts with one guiding principle. Transparency is always your greatest protection. The first and most critical rule is never, under any circumstances, try to break up deposits or withdrawals to stay under the $10,000 threshold. As we have established clearly, this is not a loophole. It is a federal felony. Transparency and communication with your bank about large or frequent transactions is the right approach. It can actually help expedite the process and avoid potential issues, demonstrating good faith and legitimate activity. If you have a large cash sum to deposit it all at once and let the routine CTR be filed. That single honest transaction is infinitely safer than a pattern of smaller ones that looks like you are hiding something. CNBC. The second rule is to keep meticulous records. If you sell a car for cash, keep the bill of sale. If you receive an inheritance, keep documentation from the estate. If you run a cash business, keep your daily sales records. If you are ever questioned about a large deposit, documents showing you previously declared this income, like past tax returns, will help prove the money was already accounted for. Experian. The third rule is to make sure your bank deposits match your reported income. This is the fundamental check that the IRS applies. If there are legitimate reasons your deposits exceed your reported income in a given year, a one-time sale of a major asset, an insurance payout, a legal settlement, document it carefully and make sure it is properly reflected in your tax filings. The fourth thing to understand is that banks can and do maintain customer relationships after filing a SAR. The filing does not mean you will automatically lose your account or face immediate investigation, but it does mean there is now a federal record associated with your banking activity. The goal is to ensure no such record is ever necessary in the first place. Accounting today. Finally, if you ever find yourself facing a government inquiry about your banking activity, do not try to handle it alone. Consult a tax attorney or an enrolled agent, someone who specializes in representing taxpayers before the IRS. The legal landscape around these issues is complex, and the stakes are too high to navigate without professional guidance. Here's the truth that the title of this video promised you. The $10,000 rule is not a conspiracy. It is not the government scheming against ordinary citizens. It is a law with a legitimate purpose, tracking large cash flows to combat money laundering, drug trafficking, and tax evasion. Most people who trigger a CTR never hear another word about it. But the system built around that rule, the SAR filings, the structuring laws, the civil asset forfeiture powers, and the IRS's ability to pull your bank records without a warrant, is something that every American deserves to understand fully. Because the cases of Andrew Clyde, Jeff Hirsch, Randy Sowers, and thousands of others prove beyond any doubt that innocent people can get caught in this machinery without ever intending to break a single law. In 2025 alone, SAR filings hit record levels. IRS criminal investigations achieved a 98% conviction rate using bank data. Nearly 80% of their cases were tied to suspicious activity reports. The system is more active, more sophisticated, and more powerful than it has ever been. Tampa. Knowledge is the only shield available to ordinary Americans in this environment. Know the $10,000 CTR threshold. Know that the SAR threshold starts at just $5,000. Know that structuring, even with perfectly legal money, is a federal felony. Know that your bank is watching your patterns and that the IRS can access your records with nothing more than an administrative form. And know that transparency, accurate record keeping, and honest tax reporting are the 3 pillars of genuine financial protection. If this video gave you something important, a fact you did not have before, a rule that could save you from a devastating mistake, please share it with someone you care about. Financial literacy is not taught in schools. It is not promoted by the institutions that benefit from your ignorance. Videos like this one exist because people deserve to know how the system that governs their money actually works. Thank you for watching. Stay informed, stay protected.